Hello, everyone. Today is Friday, March 25th, 2022. My name is Evan. Welcome back to our weekly stock market analysis video series. If it's your first time tuning in, welcome. Thanks for being here. Thanks for joining us. Here's how these videos work. We break up our analysis into two parts. In part one, we look at everything that went on this week in markets. We go beyond price action and we try and make sense of correlations, market internals, volatility, credit markets, and really sort of just pick apart things that stand out, look different, interesting, or notable. And then in part two, we jump into the charts. We look at those longer term trends. We analyze price action and try and best position ourselves looking ahead. So hopefully that sounds good to you. Let's jump into some of the takeaways, some of the highlights from this week. Big story is we've got interest rates that are not stopping. We continue to see multi-year highs in a number of maturities. And in fact, we're getting more and more yield curve inversion going on. That's where the shorter maturities actually yield a higher interest rate than the longer term, to keep it very simple. And we're starting to see more and more of that creep in. Usually that's a traditional recession indicator, bear market indicator, and lots of eyes are certainly on this as we have the Fed, who has right now a policy that wants to raise interest rates 6, 7, 8 times. I forget where we're sort of triangulating at this point, but their mandate here is that they want to combat inflation and continue to raise those Fed funds rates over the next year. So we'll see certainly how that progresses, but the bond market interest rates certainly are expressing their view. We have equity markets that continue their rally. So we saw more follow through, broadly speaking. There were some sectors, some select stocks that did not follow through, but we saw continued strength in equity markets. And if we take a look at high yield, which we'll talk about a little bit later, we do see a little bit of warning signs there, of course, tied into certainly what interest rates are doing, but we see a little bit of a rollover in corporate credit markets. So let's jump into the numbers now. We see that we had a mostly positive picture here for the U.S. markets. We saw the Dow Jones up 0.3%, S&P 1.5% upside, and the Nasdaq 232 basis points there to the upside. We saw the Russell 2000 did close negative here, so a little bit of divergence. And we also saw world stocks, international stocks, minus United States, close mildly negative here. But also, I think what's interesting is now if we take a look at the 1 month trailing returns for U.S. markets, you can see that we are in the green here despite all of the calamity, the chaos, the worry, the concern over the past 6 weeks and the slowing growth narrative and the geopolitical issues and the Fed stance. We actually have a 1 month positive performance here for equity markets. Now, if we continue on here, we take a look at market internals, we go underneath the hood of the market, you can see that things have been improving. That is obviously a relative term, but we do see on the week here that we had 181 net 52-week highs. That's in aggregate over the course of the week. And as I always like to remind, Friday numbers here are preliminary numbers. They're estimates by me. So this is not a final number here. These could change, but still a positive picture for the first time in a while for market internals. And if we take a look at the NYSE AD line over the week, we saw a little less constructive, but mildly positive. Take a look also at the percentage of stocks over a 20 SMA here in the S&P 500. We're running hot right now, 85%. So you have almost every stock that is in a short-term, medium-term uptrend, depending on your definition, right now in the S&P 500. If we take a look at those NYSE 52-week highs minus lows plotted over the past 30 days, you can see this is the trend. The trend from a 30-day perspective, from a longer-term, intermediate-term perspective, is still suspect. It is still to the downside. You can see we're essentially making lower highs here in this picture, and that still tells us that we want to be a little bit concerned or a little bit suspect here on this market. So it's nice to see the improvement. It's nice to see that we're starting to flatline here, but we have not yet changed this trajectory for the time being right now. Sector performance, lots of green out here. Energy back in front, 6.62, impressive week leading the charge here for all of the sectors. We saw materials in the second spot. We saw utilities in the number 3 spot. 3% move for utilities. That's a big move. I believe that is all-time highs for utilities. Tech was in the 4th spot. If we look at the downside here, we saw healthcare, real estate, the 2 in the negative, the red this week, the only 2 in the red. And we saw consumer discretionary in the 3rd underperforming spot here, down 0.82%. If we take a look at correlations, I do think correlations are interesting here. So these correlations are just looking over the past 10 days, 2 weeks of data, and this is inherently noisy. I don't think we should be drawing, entire trading systems off this or big broad theses, but we do still have notable correlations going on here. Take a look at the bright green all across risk assets. You're essentially seeing no distinguished action between, small cap stocks or, technology stocks. You're seeing everything really just move with high correlation in lockstep with one another. That standard or the old sort of cliche, is it a risk on day? Is it a risk off day? And that's really kind of the behavior we've been seeing. You can see lots of bright red down here. Take a look at the UUP, which is the US dollar index. You can see how that's moving very strongly, negative inversely correlated to equity markets. You can also see TLT here, which is the long bond, and that is also pretty strongly negatively inverse correlated to what equity markets are doing right now. So you're seeing very broad strokes going across markets here in rotation of capital. I do think that's notable. This is typically during periods of higher volatility, market stress, and just generally concern when you start to see correlations like this all sort of line up and be pretty bright in terms of their high correlations. Okay, so this brings us to volatility here, and volatility is notable this week. The VIX is notable. We have a correction in the VIX. Let's call it what it is here. We were trading north of 30 in the VIX just a week and a half, 2 weeks ago, north of 30, almost 35, I believe it was, and now we're trading around 21. So we've had, 40, 50% kind of correction here in the value of the VIX, and that's going from sort of peak fear 2 weeks ago to what I would consider more complacency now. We've seen this very impressive bounce off of the lows. We continue to see the equity markets stay resilient here, and I think we're maybe thinking the general market here, when I use the word we, is maybe thinking this is some V-shaped recovery, that we're going to continue to climb higher here. That's certainly how the market is trading, and I'd be very careful now. This is where I get a bit more concerned when I start to see these things like the VIX go into what I would consider a complacency area while we're coming into resistance, while we've rallied 10, 15% in some of these sectors and industries. This is where, the warning signs start to creep up here. Generally speaking, from a structural perspective, I like when VIX goes lower, but it just needs to be in the right context. And I'm a little worried about this context. Again, I don't think this is a single signal that should get you to sell everything right now, right? That's not the message, but I do want to raise the fact that we are now back down to a 21 VIX, much different than where we were 2 weeks ago. If we take a look at interest rates and credit, that's right, I couldn't get this data to load, so apologies for that. I don't know, I was having a little bit of issues with my data provider, and I'm a little bit pressed for time, so I didn't have time to debug this. So we can't look at the yields. I can assure you, though, the yields were higher this week, and we had, again, this is what I led with as one of the highlights from this week. We had investment grade bonds, high yield bonds here rolling back over. So they are negative here. They are negative on the 1 month. This is, every market environment's a little bit different, but generally speaking, these tend to be correlated with equity market performance, or you want to see kind of risk on trading in line here. And I think the fact that these are sort of, rolling back over, I think we've got another sort of warning sign here. We want to pay attention to the fact that LQD, J, and K are starting to move back towards their recent lows. Finally, if we take a look at dollar and commodities here, not a care in the world. Everything's green. Dollar index is higher, and so is every commodity on this screen: gold, silver, Bitcoin, ag, and the oil and gas trades very sharply higher here. And you can see positive performance on a 1 month basis everything in commodity land. And again, this is obviously driving home the one of the primary issues out there, or thorns in this market, which is the very high inflation numbers. So put the report card together, got 3 check marks, 2 X's on the board here. We got a B, but I am personally looking at this as a very weak B and a little suspect of a B. This is, objectively looking at all the data, but I think when you put the data in context, I'm a little more concerned about this market right here, right now, than this leads us to believe here. So that is the analysis wrap up there. If you take a look at our trading systems here, so we've got our Merlin trading system at the top. You can see this is this is looking out basically a month or two. It's a longer term trading system, maybe a little slower pace than some of you active traders out there. It's 40% invested in this market right now, so it's got a good amount of cash. It's not aggressive, but it's participating. It obviously enjoyed this rally this week, and it's a little bit slower to move. I think the positioning here does make sense given all the sort of trends out there in the market. And it continues to essentially raise cash over time is what it's doing, taking profits and sort of keeping them in cash. Our shorter term trading system here, you can see is net short going into the weekend. It's got about 34% exposure, nothing too aggressive. It did have a lot more shorts on earlier this week. It did trade very tactically around them, had some winners, had some losers, did come out ahead, even though it was shorting kind of earlier this week. Do think it, kind of held its own and made a little bit of money this week, but it is going into the weekend with a good amount of cash, 34% short. And, the way I like to allocate to these trading systems is kind of 50% to one, 50% to the other. And my positioning here in aggregate is basically neutral, right? Because I have a 40% long book on Merlin. I've got a 34% short book on Lamerick. And so I'm essentially fully hedged right now with positions on both sides. So I like the positioning here. And again, we have a lot more information about this. If you need some new trading systems, new approaches to the market, new ideas, check out the $1 trial we have. You get access to both of these 2 trading systems for 2 weeks. See if they can help you. And with that, we'll be back here in just a moment with part 2. All right, we are back here. We've got TC 2000 open. We've got our equity market grid showing. We've got a custom smart trend filter we've developed for this platform, also for tradingview.com. It's our smart trend filter. It's these multicolored dots you see on here. Helps us measure trend strength in a very objective way based on price and volume. And we're looking at a weekly time frame. So first thing that's notable here is that we are getting transitions back up into the neutral zone here for the S&P 500 and for the Nasdaq 100. This is pretty notable. These markets and indices have both been in a sell signal, in a sell state, a bearish state on the weekly time frame for at least a month, in the Nasdaq's case 2 months, and we've seen enough of a bounce where this is starting to creep back up into neutral territory. Now, the way we traditionally like to use this indicator is we give the benefit of the doubt to the prior signal when we're in this neutral state, but the neutral state tells us that there's cross currents, there's mixed signals, it's time to manage risk, it's time to maybe, do partial positions, partial hedges, whatever your interest is, your motivations are in the market. That's kind of what this neutral state tells us. So we are back above our trend filter. We're in a neutral state. It's not a buy signal, but we are going to pay attention to these markets a little bit closer. You can see the Russell 2000 was the first to produce a sell signal. It's in fact still in a sell state here. You can see it was negative this week, so not getting enough strength to push back over. Same thing with world stocks here, ACWX in the bottom right, international stocks minus United States. You can see also still in a sell signal. Down to a daily chart, you can see that on a shorter term basis, we were riding this uptrend here. We were riding a buy signal in all of these markets throughout the course of this week. So we got buy signals that were produced last Friday for the S&P 500, which essentially said, okay, coast is clear. Let's try to thoughtfully be long this market. And that did prove to pay off in the S&P and the Nasdaq. IWM, we did get that buy signal as well. Hasn't really done a whole lot, but that's kind of the lay of the land here. And we didn't get any real change on this shorter term time frame. ACWX also green down here as well. So let's take a look at some price action. Let's see what we can learn learn if we're starting to look a little bit closer here at, some of these levels that we've been mapping each and every week. So if we kind of take a look at, say, this view first, right? This is a very simple sort of triangulation that's been going on. This was the compression that we saw. We saw lower highs, we saw higher lows, we saw this tight 5-day, consolidation here. This was right around the Fed, right before Fed meeting, and we saw the markets break out from this series of lower highs and continue and to proceed to the upside here. Our stance last week was pretty optimistic, right? We thought, looking at this weekly chart, that this could be this week one sort of igniting bar, and that we in fact could get back up to the 4550 to 4600 range. That's sort of the message we had ending last week, coming into this week. And that seemed, obviously with hindsight now, seemed pretty spot on. The market continued to push up here. And now that it's getting back up into this 4550 to 4600 zone, this is where, again, I'm getting a little more cautious. The market at this point has enjoyed approximately a 9% bounce here in the S&P 500, and that's quite a good amount of ground here as we start to now come back into these bigger levels, the February highs, and some of this old, consolidation, the supply that's been overhead here from the fourth quarter of 2021. This is where I start to get a little bit more cautious. I think the gains are going to be harder to fight up here, and I would still be keying off of at this point now. See if I have any of our old levels drawn on here. I've been changing these boards. I need to reorganize. Yeah. So back to this sort of band in here, which we had way back in the day that we put this in, but we're kind of coming back into this stiff zone up here. And this is where I just, again, would be much, much more cautious. If we take a look at the Nasdaq 100 and we switch over to this view here, again, this is the same kind of analysis we had recently. We had lower highs, we had higher lows, we had some compression, we had a little bit more of a relative weakness play down here, but then we did get the breakout of this sort of downtrend that we've had, and we are starting to, push back up again to these February highs, the 365 to 370 zone. And again, in the Nasdaq 100, we've covered basically 13% in a very straight line in about 7-8 days of trading. So we really caught, I think a lot of negative sentiment. We sort of really squeezed some maybe late short sellers here, and really created a lot of FOMO over this past 5, 6, 7 trading days to the long side now of people wanting to chase this market into resistance, which I think is getting a little bit dangerous now. Russell 2000, you can see again, didn't do a whole lot this week, kind of consolidating over here. I actually like this. I like the consolidation. In fact, out of all the markets, I still actually like the Russell here in the short term the best. This has got some of the best structure, just broadly speaking. It's showing its strength. It's acting in a pretty healthy manner here, and it's not just straight vertical for 8 days. So the Russell, I do think is interesting, but of course, this is the beast here is the year-long overhead supply that it's kind of coming into. So that's the real roundup there on the major markets. I am more hesitant, and I am a little more cautious up here at 4550 to 4600. It's not a sell everything type of mentality. I think it's where the tactical traders now, the active traders, the traders with experience in managing volatility are going to start to, excel during this time, because I think things could get just a little bit murkier here next week. Now, if we take a look at VIX, this is one of the concerns I have about this market. This is the crash mode for the VIX. We were trading, that's right. So in fact, I said up to 35, but we even got up to about 37 just 2 weeks ago. And if we, kind of look from those highs to where we are right now, we're basically 45% off of those highs. So this is probably the better spot to panic and to worry and to buy protection and to hedge, right? Again, it's not everybody's got different time frames. So I hate using those types of blanket statements broadly. But this is where I would be looking at that type of trade when we're back down here around 20 VIX. Next up, if we take a look at oil, you can see oil, we looked at this a couple weeks ago. We saw this very quick, swift 22% kind of pullback correction off of highs. That proved to be all we got. And the oil at this time is basically 20% off of this pivot low here. So we're coming back up to these previous highs. We've got a little divergence here in momentum. So this is where, again, be a little bit more pessimistic here on oil as it retests this level. Again, I would not want to just blindly short a runaway trend to the upside with lots of geopolitical potential catalysts. So just be aware of that. You need to be able to manage risk, but I'd be really paying attention and keying off of how it responds to around 84, 85 or so. If it can get back up there, and maybe some tactical shorts. If it proves to start to fail there. We already looked at VIX. What else do we got? Treasuries, TNX. So this is the 10-year treasury yield. This continues to push higher here. No stopping, no concern. Doesn't care that it's overbought. It's riding this upper Bollinger Band trend. Continues to be the case. Take a look at a weekly Bollinger Band on the 10-year treasury yield, and you can see that we are entirely closing outside of the upper band here. That doesn't happen too often. We, had this run up in January 2021 before we start to fade down, but we see just continued impressive strength here. And right now, that's in the face or, kind of continued dollar strength, continued equity market strength, continued interest rate rising strength. So that, I think, covers all of the stocks indices I want to talk about. Let's finish off with some sectors and industries of interest. So this week, we've got a lot more on the bullish side. And I have been actually, so I'm finally, we should be releasing this layout here. If you're a TC2000 user, you like this layout. This should be on the website. If you're on our email list, you'll get notified. This should be getting released next week, so you can have this. You can scan on your own, and you don't have to rely on me. But basically, here we've got. I'm going to just extend this list here. I'm not going to go through all these names, but basically, you can see a lot of energy, different energy industries here. So oil and gas, E&P. You got integrated oil and gas. We got oil and gas midstream. Right down the list, got a lot of basic materials showing up here, chemicals and the like. And I'm going to extend this to the right. You can pause the video here. You can take a look at the different industries here that are showing up on our bullish scan. And you also got some sectors down here, utilities and materials, as well as semiconductors. On the downside, we had three. So we had auto and truck dealerships, high volume, low close. We see technology, data storage continues to sell off pretty aggressively. And we see home improvement stores, it's like Lowe's, Home Depot, continues to sell off here, heavy volume and, weak close here to new multi-month lows. So that's it. That's what I have for this week. Lots going on, lots of excitement out there. But again, let's, focus on risk management. Let's keep an open mind. Let's understand where we've come from after a strong rally. And of course, make sure everything fits your time frame, your risk tolerance, et cetera, et cetera. So that's all I've got. Thanks as always for tuning in and listening. Every Friday, you can subscribe to our YouTube channel or catch us at thetraderisk.com. Leave a comment below. Let me know what you're looking at this weekend. Always interested to hear your sentiment, your thoughts, your comments. And with that, thanks so much. And we'll catch you in the next video update.